All right, guys. So now we're going to go ahead and take a look at the wheel strategy for passive income. And if you've already watched the covered call and the cash secured put lesson, then this will just be kind of a refresher. But you are going to learn some, new things as well in this strategy. Because really, what this involves, as I was mentioning in those lessons, is you're going to, sell cash secured puts, and then you're also going to sell covered calls. So it's really simple actually, and we're going to get into this here. So, what is the wheel strategy? The wheel strategy involves rotating stocks for options premiums between cash secured puts and covered calls. So, the strategy begins by using your cash to sell a cash secured put. So, you're putting up collateral, right? I want to buy 100 shares of Apple. If it goes down to 130, it's at 150 right now. So, I'm going to go ahead and sell a cash secured put at the 130 strike. So, you put up that cash as collateral, and then you receive the premium for selling the cash secured put. If the stock finishes below the strike price, then you get long the stock for 100 shares, of stocks. That's per contract that you sell. Now, at this point, what you do is you turn around and you sell a covered call against your position at the same or similar higher strike. It really depends, and we can get into that with some specific examples. But typically, you're going to want to sell for the same strike, if not a higher strike. So, like I said, we'll get into that, but this allows you, the option seller, to generate consistent passive income whether or not you are already long the stock or looking to get long with a cash secured put. Now, the important thing to keep in mind here, the fifth slide, right, or the fifth bullet point, the more volatile the stock is, the higher the premium in the options, but also the higher probability the stock can move against you. So I was talking about this in the last lesson with cash secured puts. If you have a stock like Palantir, which is extremely volatile, the premiums will be higher for that. But keep in mind, the volatility is also very high. So if earnings come out for Palantir and the stock goes down 20% and you sold a cash secured put at the, let's say, $9 strike, and now the stock's at 6 or 7, right? Well, you can still sell a covered call once you have to get long those shares because it's in the money and the buyer of that put option will exercise. But nonetheless, it's just something to keep in mind. Like if you have a stock like AT&T, for example, or Verizon, those stocks are going to be a lot less volatile. Now, those stocks also pay dividends, and we're going to get into the wheel strategy and how that could potentially work with dividends as well, specifically with covered calls. That's the main thing. We'll get into that in another lesson. But that's the last point on the list here. You'll see dividend stocks can also work great for this strategy. So we'll get into that here. I'm going to touch on that briefly, but also in another lesson entirely. So, example of the wheel strategy, right? So XYZ stock is last traded at $50 per share. You sell a $45 strike put option about 1 month out to expiration. And let's just say, hypothetically, you collect $500 in premium. The premium is yours no matter what. Now, if XYZ finishes below $45, you get long 100 shares, and now you can sell a covered call at the $45 strike for what we will assume is an additional $500 in options premium, about a month to expiration once again. So in a 2-month span, hypothetically once again, you made $1,000 from your cash secured put and covered call trade. So no matter what happens, you keep that $1,000. It's about 22% of the original trade amount and a stellar return. Now, probably not this great of a return in real life, but you get the picture. So hypothetically, right, you can run the numbers on the initial trade amount and then how much premium you're actually receiving for selling these options. Now, the reason, once again, just as a refresher, if you have a put option, the buyer of that put option will exercise that if the stock is under 45 upon expiration, and vice versa with a call. And so what you have to keep in mind, like if the stock is above $45 and you sold a covered call at that strike, or vice versa with a cash secured put, it's going to be auto exercised by the options clearing corporation. And so regardless of your intention, right, or regardless of if every single options contract gets exercised essentially. So upon expiration, if the option is 1 cent or more in the money, you will receive an exercise notice if you're still long or short the option, regardless, right? It'll be auto exercised. So if you're the seller of the option, you just have to keep that in mind. Holding till expiration, the stock's at $40 per share, you're still getting long that stock. If the stock's at $50 per share and you just sold a call, you're still selling your shares at $45 no matter what. So there's really no way around it, and there's no free lunch. So you just have to keep that in mind. Now, like the fourth point here, the biggest risk with selling a cash secured put, for example, I mentioned this in the last lesson, but $45 level, right? You sell that put, you collect the premium, but what happens if the stock, goes down a lot? Well, you can still do the wheel strategy, but like I was saying with Palantir, around earnings, say the stock goes down to $5 or $6, and you sold a cash secured put at $8 or $9. Well, you're going to get less premium for those covered calls now, and you'll have to wait for it to hopefully rebound to those levels, because otherwise, it's essentially like the more it goes out of the money, right? The less premium you're going to get from selling those covered calls, or vice versa with a put. If the stock rises a lot, then you're not going to get as much for selling that put at the same strike. So it just comes down to how much the stock moves. That's why, I was mentioning the dividends, right? Well, dividend stocks typically have lower volatility. Now, with that lower volatility will come lower options premiums, because there's not as much risk that the stock will make a big move. So that implied volatility will be lower. Having said that, doing this against dividend stocks, right? The wheel strategy, and then, getting long the stock and selling covered calls can allow you to also collect dividends as well. And if there's lower volatility, there's less chance that the stock will make a big move. And so you can keep on a lot of times selling a similar strike or the same strike, and not have to worry about the stock making like a 10 or 20% move on earnings. Obviously dividend stocks can still move, but they're not typically going to move as much as like a growth stock like Palantir. So, if you look up Verizon stock, or if you look up Procter & Gamble stock, PG is the ticker symbol, or VZ versus Palantir, PLTR, you're going to see the difference in terms of the volatility, and it's pretty substantial. So you'll get less premium for selling options against a stock like Procter & Gamble, or Caterpillar, for example, or any of those more stable names, McDonald's, Verizon, Coca-Cola. Less premium, but also less volatility, so less having to worry about the stock making a huge move, which if you're actually trying to live off this, right, that can be very important. And we'll get into some specific examples in the next video. But, that's what I was going to mention here. The next video will be live examples, so that'll be in the next lesson. We're going to be using Thinkorswim again. And then I'm also going to take a look at TD Ameritrade. So essentially, TD Ameritrade or Thinkorswim, they're combined, right? So you can use either one of them, but I'm also going to show you how to do it more simply in TD Ameritrade as well, because Thinkorswim is more advanced, and so you might not really want to use Thinkorswim. You might prefer using the TD Ameritrade website. But as long as you have the proper options approval, anybody can pretty much do the wheel strategy, sell puts, sell calls, make passive income from doing so. And if your broker does not allow any form of options trading, then you need to find another broker. I like TD Ameritrade. I like Charles Schwab, and they're both good brokers. And Charles Schwab and TD Ameritrade will be joining together here in 2023. So dividend stocks, right? I just talked about it, but let's talk about it and go over it one more time here. So just to get this kind of drilled down, doing the wheel strategy against lower volatility stocks and ETFs that pay a consistent dividend, rather monthly or quarterly, can be a powerful strategy for supercharging your income, since you can many times get both the dividend and also the options premium from selling covered calls once you are long the stock. So the key is to hold the stock until the X day, at which point, if your stock is called away, you will receive the dividend. The strategy involves selling a call option that is at least out to the X day or later, which increases the chance of you being able to keep your shares and them not getting called away, thus collecting both the dividend and options premium. So as I mentioned, we're going to make a separate lesson on this, but this last paragraph I want you to really pay attention to. So there's something called the X day when it comes to dividends. Now the X day is the day that essentially if you buy that stock on the X day, you will not receive the dividend. So you have to actually purchase the stock 1 day before the X day. That is the last day you can buy the stock and receive the dividend. Now, if you sell the stock on the X day, then what happens? You will still receive the dividend. So you could essentially, what you could do, and each company announces this, and I'm going to make a couple lessons actually on this kind of strategy, but one for options and one more for just like purchasing stocks right before the X day, like 1 day before, and then selling on the X day. That's called the dividend capture strategy. We'll talk about that in another lesson, but essentially you could do that. What you have to keep in mind is that the stock will drop by the amount of the dividend, all else held constant. So like I said, that's another lesson altogether. But focusing on this, right? If you have an expiration, let's say, that's just as an example, October 31st, okay? And the X day is, let's say, October 29th, okay? So let's say the option that you sold, the covered call, is in the money. Well, more than likely, and this is not always the case, but more than likely, that option will not be exercised until the expiration day. It's auto exercised, and a lot of people just buy to close, or buy to close, sell to close, whatever your position is with those options. And so, if you're looking at, selling a covered call against a stock you own, and then the option, let's say, expires 2 days before 2 days after the X day. Well, as long as you still own those shares in your portfolio, like you have not been, your shares have not been called away. Because keep in mind, with American style options, when you're trading most stocks that trade like on the New York Stock Exchange, NASDAQ, they're what's called American style options, which means you can essentially, the buyer of the call option or the put option can exercise that option anytime before expiration. Okay, so, but most of the time they're not going to, and that's the key, right? So most of the time what's going to happen is that you're going to be able to keep your shares until the expiration day. And if it's in the money, that's when you'll lose your shares. Well, having said this, right, let's just, run this probability here. The probability is, even though, let's say the option is well in the money before the expiration day, chances are you'll probably still get to keep your shares. Not always, but until the actual expiration day. And so if the expiration day is 2 days after, or even 1 day, or even is the same day as the X day, and that's when your shares get called away, you'll still receive the dividend. Okay, so you can kind of get the dividend along with the premium, right? So that's the key. It comes down to the X day. So I would do some research on the X day and kind of, look at that a little bit closer for specific stocks. Like each stock will have an X day. And remember, you want to make sure you own those shares 1 day before the X day. If you sell on the X day, you still receive the dividend. If you buy on the X day, you don't receive the dividend. It has to be 1 day before. So that's just an important consideration. And we'll get into that more, like I said. All right, so just going over this one more time, okay? It's pretty simple. We've talked about covered calls. We've talked about cash secured puts. So we're just going to keep on rotating this. That's why we call it the wheel, right? You first sell a put on a stock that you want to get long, probably out of the money, unless you really want to get long that stock and it's in the money or it's at the money. But if you want to get long a stock, you're probably selling an out of the money cash secured put. Now, if the stock drops down to that strike, you simply get long the stock, and then you turn around and sell a covered call. And essentially, if it goes in the money with that covered call, then you turn around and you sell a cash secured put. Now, with options, right, you can do this on a weekly, bi-weekly, monthly basis, quarterly basis to receive the cash flow you desire. So most options contracts, when you're looking at stocks, you're going to see that they have weekly options. They have monthly options. They have, 3 months out to expiration. So you can choose exactly what you're looking for. Of course, it's really going to come down to your risk tolerance. Like, if you have a weekly option, for example, there's going to be a lot of theta decay or time decay in that option versus a monthly option is going to have much less theta or time decay. And so that's just something to keep in mind and consider. So the major risk, with the wheel strategy is that, the stock finishes down big on expiration day from the strike price, which you sold the cash secured put. And so, like I was saying, it all comes down to volatility. It all comes down to specific events that can move the stock price. And ask yourself, how volatile is that stock? We're actually going to create a separate lesson and talk about how you can gauge volatility for a specific stock and look at all the different factors associated with a stock and determine how volatile is it relative to the rest of the market. That's called beta. So when you're looking at the beta of a stock, implied volatility for those options will be related because of how volatile that stock generally is expected to be. And like I said, we'll get more into that. But the next lesson here, folks, will be we're going to go ahead and look at some specific examples, once again, of the wheel strategy and how you can implement this against your portfolio. And so the wheel strategy is one of those things, I want to take over to Thinkorswim, and it's definitely my favorite option strategy, okay? But we're going to do that in the next video, so let me go ahead and log in here, and then I'll see you guys in the next video. We're going to go over to Thinkorswim and also TD Ameritrade. I'll show you some live examples, and we'll go from there. All right, see you guys in the next one.